And the first task, almost inevitably, is getting past this conversation. Where do you think prices will be in 1 month, 3 month, 1 year periods, right?
Hey everyone, Doug Stetzer here from EKT Interactive, and I'm excited to announce The Hedge, a new podcast with longtime friend and colleague Steve Sinos of Blue Lacy Advisors, an energy risk management consultancy. I've known Steve for a long time, and he's one of those people that I just seem to learn a lot from whenever we talk. So I pitched him on the idea of recording some of our conversations and launching this podcast. He agreed, and I just really think our learning community will benefit from his experience and knowledge. And in return, I hope we can get the word out about Steve's new company, Blue Lacy Advisors, and the risk management services that they provide. The Hedge will be a mix of conversations tailored for our Energy 101 audience, sort of a Hedging 101, as well as a discussion around solid risk management practices and how they are influenced by or react to current events, price volatility in the energy markets. So I think a lot of people in energy will learn a lot and get a lot out of these conversations. If you're already part of the EKT learning community, then you know who we are. So I thought I would mainly use this first episode to introduce Steve. And honestly, since he's the expert in this field, you'll find he does most of the talking. I'm just here to hopefully not ask stupid questions. We hope you enjoy these conversations as much as we do. So let's get started with this first episode of The Hedge.
Yeah, no, I think we've known each other a long time. So I think we tend to get into good conversations. Sometimes I look back, like you said, like, man, I wish I was recording some of those nuggets or at least taking notes. And so I was excited to get it on, get it recorded here. And for sure to get the name out there. Blue Lacy's only a year old. Actually, this is our year anniversary this week of filing with the state to have, official recognition for tax purposes. And not coincidentally, then like we're putting together all of our different vendors, and it's really been a nice reception so far, but still nobody knows, like it's hard to say anybody knows who you are when you just get started. And so I was excited to be able to share it with with your regular listener, and like I've been in, so I think I've been doing this for 20 years now. I started straight out of school, and you ask kind of like, what is the niche and how do we find it? It was through these conversations, right? Like over time, you would talk to people and there were a handful of questions that just kind of never seemed answered in ways that were satisfying to our clients. And more so, those questions sort of always needed to be answered again, right? And it's not definitional stuff like what is a put and how do you use it? What would you use it for? It's more like this thing happened today or this week or this month, and that, makes me question whether my original strategy still makes sense. Now what? Right. And that, I think they all boil down to that question, sort of now what?
Right.
And Blue Lacy came about just sort of a series of iterations. And quite frankly, I got tired of being laid off. You know what I mean? Like in our world, you get laid off every couple of years, whether you're doing well, is sort of secondary to how the market's doing. And by the end of 2013, I had been in the industry for 10 years and been laid off 3 times, and I was just kind of tired of it and needed a break. I was physically, emotionally, and mentally exhausted. Took a bit of the garden leave. They paid me to go away, and so I took advantage of it. Put my dog in the truck and traveled the middle of the country here, and kind of came back thinking what I really liked about this industry I could do on my own. Right, I didn't need a major brand behind me to have these interactions, and so it's been a total of about 10 years as an independent advisor. And just in the last year, really truly on my own with my own shingle, my own website, all that sort of stuff, paying the bills through the vendors, all that stuff on my own. And so, it's so far so good. It's been exciting to grow. And I think proving out the thesis, we benefited from timing a little bit. The 10 years leading up to this year were rather boring, right? Folks got lulled to sleep in a comparatively low vol world, low cost world, high growth. Maybe some of the E&P guys struggled to make money because of that competitive aspect of it that depressed energy prices. But now we're in a high vol, high cost, high commodity price world that It's possible that across the value chain we have winners and losers, and so I think it was the best time. I didn't do it on purpose, but it was one of the first time in my career I think I benefited a little bit from timing. So
Yeah.
hopefully we
Well,
can run with it.
yeah, and you mentioned something there that I just want to like dig into just a little bit, man. And it's that word reactionary. Like you were talking about, talking to clients and they're calling you after the fact, after something's happened. And I think that's kind of gets to the heart of hedging services and the conversation that you probably have with people is shifting from a reactionary, standpoint of like, oh my gosh, if you're a consumer, prices have doubled and it's, hurt my bottom line. Or if you're a producer, like, oh my gosh, prices are falling and I've got to meet my debt obligations. Like that shift from reaction to having a plan has got to be, a conversation you have a lot. And, is that accurate? Like, is that how you would describe it? And what's the kind of like the process for taking someone from one phase to the other?
Yeah, so you're 100% correct, right? When people are thinking about their businesses, they plan in a spreadsheet world where prices, costs, revenues are all boiled down to dot point line items, right? Oil's going to be $80, natural gas is going to be 7, whatever it is, right? Diesel's going to be $2.50, whatever it is. And they're like, okay, this is good. Today looks good. Let's exaggerate it a little bit just to be safe. And banks are terrible at this too, right? They've got their forecast prices and they're like, well, let's just discount that by 20% just to be safe, right? And most of the time that kind of works. And it really only kind of works, but for the most part, it's how people do it and they're used to it. And so they're comfortable with it. And then something goes wrong, something breaks. Like, man, this is now going to be this huge problem. If you would have called me before, we could have prevented it, but let's worry about that later. How can we address this? And there's no repairing a position, right?
Mm-hmm.
Once it's broken, it's broken. The question is, what can we do now based on what we know today to address the market as we see it, or our losses or gains? Hopefully, if you're lucky, there have been some gains, right? To make this part of the process. And so often it's not until year 2, and call it 9 months in, you start thinking about the second budget year we work together, to where you really are able to unlock value. There's a solid period at the beginning where we're learning each other's tendencies and needs, and that can't in ways that can't be quantified, right?
Mm-hmm.
Be very easy for me to sit down with a huge consumer, right? FedEx just reported recently and made headlines because people tend to think of them as a bell cow for the economy overall, right? It'd be easy for me to sit down with the CEO of FedEx and say, here is how sensitive your business is to the changing price of diesel. He probably already has an analyst internally that's doing that. But the rest of the conversation is, okay, realistically, what does the price of diesel say about your business? What is the rate of change of the rate of change, right? So how quickly can things change based on what we don't know, right? And then how much of that do we need to think about as a strategy support mechanism, right? Like their actual business isn't going to change. They're going to deliver packages and charge people for it.
Mm-hmm.
And they're going to hopefully make profit, right? It's a rather thin margin. And so there's a risk there that their assumptions at the beginning, right, are quickly violated by something that changes on a daily basis. And 2 to 3%, and on an annualized basis, typical rule of thumb would be like 20 to 25%. But right now we're talking about 45 or 50%, right?
Right.
So FedEx's 3 or 4% profit margin over the last few years, right, the trailing 12 months, very quickly goes negative if that component, right, isn't addressed ahead of time. And that conversation usually can't happen until year 2, unless the client had the foresight to sit down and be a little bit more introspective about what sensitivity analysis means, right? Get out of the spreadsheet and ask yourself, in a scenario where diesel prices are rising, in this example for FedEx,
Mm-hmm.
it's likely, if not, it's likely that their business is possibly improving, right? Because there's more demand for transport, possibly more demand for FedEx's services. So what is their true risk in that sense? And how often then do those prices keep rising, even after we've hit that peak growth that is, that FedEx, falling revenues would suggest a turn in the economy, right? And how do we manage that mismatch between the two?
Mhm.
And once you can get to that conversation and become part of the forward-looking planning, right? Once you're working with the FP&A and the treasury analysts to do more than just manage someone else's expectation of prices or fear of changing prices, you can really add a lot of value. And what it tends to do then over time is minimize that variation in your success metric. Not just talking costs, but if you can minimize, right? If you're talking about 3 or 4% profit margin for a company like FedEx,
Mhm.
how variable is it over time? And how much more value does that company have if you reduce that variability? And the same goes for an E&P company, right? Their profit margins are much more volatile as a result of being commodity dependent, right? Devon's most recent profit margin was something like 25%, 24%. But there were a string of years where it was zero to negative. You know what I
Right.
mean? Like,
Sure.
and that wasn't necessary. It's not necessarily avoidable, but it wasn't necessary to have that level of volatility. And you can boil it down to answering the question for each company, which would be different, right? Like, is how much variance in that margin is acceptable, and how much do I need to spend, or am I willing to spend to minimize that variance? And sometimes you come back and say, well, the variance is really only, 1 or 2 percentage points, right? And the cost of managing that's going to be greater than that. So it doesn't make sense. But often it's like, oh, the variance is actually quite wide. And in those years where that profit margin would become loss, right?
Mhm.
I would want that insurance, right?
Right.
It'd be necessary to stay a going concern,
Yeah.
and that tends to be easier to work with large consumers because they're not in the energy business. I mean, they are by accident because sometimes,
Right.
like, the 35-45% of their variable costs might be energy, but they want to be able to take the amount of unknown and define it to only those risks that they can accept. It's a little bit more
Sure.
difficult for E&P type guys or trading midstream type guys
Yeah, they
because,
want the upside.
yeah, there's an expectation for volatility there, and
Sure.
they get beat up pretty hard when they're only selling $100 oil and it's $120 print. They get beat up pretty hard in that
Yeah.
sense. So that's another piece that's hard to quantify, right? Can you withstand that? And but as a result, E&P companies, especially small private guys, go out of business more often than transport companies like FedEx, the size of FedEx, right? So
Well, and that's part of just knowing the client for sure, and that's why everyone's got a different need, and including, just the not only whether they're on the consumer or producer side, also like you mentioned, whether it's really if energy is their primary business, or if there's something that they are really looking to manage maybe a little more tightly. But then also within that, even like you mentioned really kind of briefly, there is maybe some of these smaller companies out there, they want to just like stay in business, right, over the
yeah,
long haul, and just keep spinning out cash flows to you know either investors, or even like if it's like a family, right? And so one of the things that I just wanted to there was two things in there that are kind of interesting to me. Like, first was, I think it's important for people to have realistic expectations, obviously, when you go in there. And I'm sure one of the first things you have to do is start really setting those expectations. And this idea that it's going to be a 2-year process to kind of get things in line, right? Whether you're starting from zero, or if you're making kind of a strategy shift, or if you've just been doing things maybe incorrectly. So what is something you run into? What are the first 6 months of that 2-year process, for with a new client for you? What's the first part of getting things kind of where they need to go?
yeah. So the first 6 months or even a year are necessary because you have to work through a couple of periods that are monthly or quarterly to understand their internal processes and their internal metrics, right? And their internal sort of expectations of how their annual or sometimes 5 year cycle is built, right?
Mhm.
So what I try to do is sort of build rapport up until the point where you can contribute to the budget conversation by picking out those things that they get worried about, right? And the first task, almost inevitably, is getting past this conversation. Where do you think prices will be in 1 month, 3 month, 1 year periods, right? And often people will get frustrated with me because my answer is always, I don't know,
Right.
right? And I laugh about it. And when we give presentations at things, like everybody wants to make a bet and everybody wants to be right. But the answer is just plainly, I don't know. And I'm not here to do that. If that's what you want, you need to find, right? Go find a CTA who's going to momentum trade you into the next $100 swing, or, you know what I mean? Or a hedge fund guy who's going to tell you about this spread is mispriced because of these things. The very first thing, and sometimes it takes longer than others, is to get to the point where we have mutually agreed upon what it means to be conservative relative to risk and
Mhm.
managing volatility. Inevitably, those two things tend to be said, by everybody involved, every stakeholder, right? Whether it's a small family owned oil company, like you said, that's just trying to, pay the five stakeholders forever, or it's a huge airline that's just trying to make sure that, that jet fuel prices don't corrupt its business. Those generic statements have had, I mean, like, I don't know that I could count the number of different definitions, and I seem to keep learning new definitions for them. So the first task is to show them what is volatility actually, not academically, right? Not this annualized, you know, at the money implied volatility, just realistically, what does volatility mean to you, the client, in your, three statement accounting sheet summary? And how much of it is due to things that are so far out of our control on a daily basis, right? That we have to worry about them in risk management terms, or which components of that are within our control from a physical procurement or marketing standpoint, right? Can we do something as small as reconsidering contractual terms for how we price something or the days on which we price it to better reflect your business, and then match our hedges to that? And at each time, like, it pulls farther away from or further away from anyone's interpretation of the market into understanding the first order and second order risks within your portfolio based on the decisions you made strategically, right? Your edge is in your strategic process, whether you're developing a resource or executing a service. That's your edge. Your profit margin is based on your edge in your primary business.
Mhm.
So let's not pretend to be market experts in ways that we could predict the market, right? That's a fool's errand. Let's talk about it using the vocabulary of your business and minimize it. And the easiest example I have, some of my best clients tend to be folks like airlines or transport authorities who have minimal opportunity to control their net revenue, right? It's competitive or maybe even regulated. The
Right.
utilities are another great one, right? And so the volatility inherent to even just a normal year, not even a year like this where we have had all sorts of things exaggerate volatility,
Right.
it can be damaging to the company strategy. And so the questions become, well, with how often do we need to check this, right? So it's not what do we need to do, where do you think prices are going? It's, well, how often do we need to have a conversation about the prevailing market relative to what we thought the market would be 6 months ago when we started the fiscal year, and in having a plan along the way on how to react to that, to, sort of the old cliche, right? Keeping the ship between the shores, right? Like, all
Right.
we're trying to do is get down the river, and we're not entirely sure. We have a broad idea that it's going north to south, but we're not entirely sure because of, various things that change where exactly the shore is, where those are going to be. So we need somebody looking out ahead at intervals that we can actually rely on to help us make choices, right? And so you figure out, how often do we have those conversations? How far out do we need to think about it? And then that dictates how much you need to do or with which instruments, right? And that's a process that is is at its core similar for every client, but has its own nuance because of differing budgets, tolerances for variance, and expectations of success, right? And so that, the rep might be easier right now for an E&P company with a break even of, even 60 or 75
Right.
to make some of those decisions to just be pure insurance buyers and forget about the cost. Whereas, a large transit authority is, at even higher levels of stress given the high cost and high volatility of fuels, where they may have to be conservative in ways that minimize that cost and at the expense of flexibility. You know what I mean? And so
Right.
once you get there, whether it takes a week or a year, you can start contributing to budgeting and strategic conversations, right? Because you're speaking the same language. You have this a united expectation of what it means to manage volatility, and you're the sort of right hand man to the dude, right? The who is CEO or the treasurer, whoever it is you're serving. You're there to make sure that he's right, and when he's wrong, right, the pain of being wrong has been minimized in a way to where he's still able to achieve his goals. And so you can add so much value in that sense, being their niche market expert and supporting an execution, right? Because strategy's easy, executing strategy's hard. You got to make it easier for them because it's never going to be easy in the true sense, right? It's always going to be different starting day two, you know what I mean, from what you thought it was going to be on day zero. And by day 365, you might look back and think, I never would have guessed that we would have had a pandemic, a war, a hurricane, which we haven't had any hurricanes yet, knock
Well,
on
they're
wood.
coming.
Yeah, in the Gulf. But you know what I'm saying, right? Like these things
Sure.
that are, each of them is unpredictable, but the fact that something's going to happen is predictable. Once you start getting that sort of idea that black swans, aren't unpredictable in nature, only in, in how they actually develop, like you can really start to help somebody create a consistently successful strategy. And that's really where once you get to year two, sometimes you look, they just sort of assume that you're there to help, and you don't even have to worry about some of the more basic conversations. And so you
Sure.
start thinking about, how can we share this with new people within the firm, right? Maybe they're young guys that just joined, or maybe they got transferred laterally into the system. Like, how do we, sort of incorporate them into this to make it a robust, reliable, consistent, repeatable process? It's, that's the first 6 months to a year with any client, and regardless of how experienced they are, because often it's about closing the gap between how, my brain is thinking about the words they're saying and what they mean those words to be.
Well, I think if I could sum up anything, man, and you might want to go ahead and just put this on your website anyway, is that idea that the edge is in the process, right? Like this, getting everyone on board in the process of analyzing and setting up a plan and then executing on that plan. Like you said, you're not in the predictive business. You're not trying to predict either prices or the forces that might affect those prices, whether it's natural disaster, geopolitical, or just kind of basic economic. In that, at the end of the day, everyone should sleep better at night if they've got a structure in place that makes them at least know that part of their budget is under control when
Yeah.
something like this happens, right?
Yeah. Or I might even frame it to say, like, we admit that we have no edge. And so we've done something to minimize consequences of that. You know what I mean?
Yeah. Yeah.
I think that's really what the core of risk management is. Like, you're doing a business to make money. Like, all of the things that can go wrong, we can at least, like you said, you can at least sleep well at night knowing that it's not going to be the change in commodity price that's going to corrupt your business in the coming week or whatever it is, right? Week,
Right.
month, quarter. Yeah. So I think it takes a while to get to that point, though, because for most people, like, they're so used to, especially successful businessmen, right? Like, they're so used to trading on an opinion, whether they frame it that way or not, right? I think I can do this thing better than you, and I'm going to go make money doing it,
Right.
right? And so you're like, well, we're on the other side of that coin. like this little tiny corner of your business, we know you can't do better than the market, and the market will punish you through speed. So we need to prepare, right?
Right.
And so, yeah, I mean, that's the process of incorporating that into your strategy is definitely where you find value.
I want to kind of bring it to like a little bit of a wrap for just this introductory episode, because otherwise we're just going into another topic. And
Yeah.
but again, like ending on that idea that this is a long process. There's a learning curve to it, but that when you have these discussions, there's a playbook to play from. But obviously everyone's got their unique goals and challenges within that playbook. Is there anything like you'd just like to point out just to kind of wrap up this little intro? Just anything that came to mind, and anything like just on what I just said about just getting this thing started.
Yeah, well, I appreciate it. I always enjoy our conversations. I feel like we've been friends long enough that, like I said, if we could capture them sometimes, like, oh, I need to turn that into some sort of, blog or something to run with that. If you let me talk, I'll talk forever. So if we can capture some of those and dive in, like, I'd love it, man. Cause I know it's much better for me to work through these things out loud. So I appreciate you giving me the opportunity to share some of my stuff that I don't know if I was tasked with it, I could ever just write it down and turn it into anything useful. So hopefully you guys find it useful to discuss it out loud with me.
Yeah, absolutely. I think people will get a lot out of these conversations. You know, when they're dealing with these risks and they're dealing with, notoriously volatile markets and things that just seem to be getting a little bit crazier every day. So let's just we'll wrap it up there for now, man. I appreciate you connecting and making some time. And we'll talk again soon and really start outlining, where we're going with this podcast.
Sounds good. Thanks, man.
All right.
Well, I hope you enjoyed that conversation. As you can tell, there's a ton of material to cover in the field of risk management, and I already have a ton of ideas on where to go for future episodes. If you're interested in learning more about EKT Interactive Energy Learning Community, be sure to visit ektinteractive.com, where you'll find our courses on everything from oil and gas to power and renewables. We'd love to hear how we can help your team or new hires get up the curve fast with their energy knowledge. And of course, if you want to learn more about Steve and Blue Lacy Advisors and their services, go check out their website at bluelacyllc.com. Thanks a lot, and we'll talk to you soon.